Good afternoon, everyone. This is the Vermont House Committee on Commerce and Economic Development, Thursday, January 30th, 2025 at 1 p.m. in the afternoon. We're now here to take some testimony on H99, which is an act relating to regulating earned wage access services. Ben, if you'd like to join us?
Sure.
Good afternoon.
Alrighty. Thank you, Chairman, members of the committee. Thanks for the opportunity to testify. My name is Ben LaRocco, Senior Director of Government Relations at EarnIn. I've got a couple notes. I'll read some testimony and then happy to address most of the questions that were asked today. And my colleague Ryan has a slightly different business model than ours. He'll be able to answer some questions as well. So thank you so much. EarnIn is one of the largest EWA providers in the country. Our mission is to create a more worker-friendly payroll system by giving workers access to the wages that they've already earned when they need it, instead of waiting for an arbitrary 2 or 4 week pay cycle. EarnIn is direct to consumer, which means anybody can use our services. And nationally, about 2 million people used EarnIn. In Vermont, last year, about 1,500 people used it. 3,400 total over the last 11 years we've been operating in Vermont. The top employers of our customers include the University of Vermont Health System, that's the largest employer, Walgreens, and the state of Vermont. Those are the top 3 employers. We also, even though we're direct to consumer, we have partnerships with large employers. We have a partnership with a large labor organization, and we own a payroll company that provides payroll for about 250,000 Americans. Once you work and earn money, that money is legally yours, even though your employer gets to hold on to it because payroll is complicated. So if you quit on a Monday and you've earned one day's salary, that money's yours. Your employer has to pay for it. It doesn't become yours on payday. But payroll is complicated. Payroll hasn't really been updated since the Industrial Revolution. The payroll system today is very similar to the way that people earn money. They would go to the mill on Friday, they get their money. With technology, we think it can work a lot more worker friendly, and that's what we're trying to do. EarnIn will estimate your wages, provide those wages to you on demand, and then you can access those. We talked about this a little bit. The traditional or the basic level of service, which is what we call it here, means there's a transfer over ACH. There's no cost to that. This is similar to PayPal or Venmo, where if you transfer the money over ACH, there's no fee. If you need the money immediately, there is a fee. Our fees range between $2.99 and $5.99, depending on a number of different services. We also we do solicit voluntary gratuities. This was a big issue for the committee last time, so we talked about that a bit today. But when we talked about that earlier, that's what we do. To answer your question, you don't have to pay the gratuity. We offer a refund if you pay a gratuity and then you decide you want it back. We'll refund that. It is totally voluntary, and there's some protections in the bill to ensure that it is completely voluntary. Part of the issue that we are trying to solve for is that if you are living paycheck to paycheck, you might only have $50 in your bank account, but you have hundreds or even thousands of dollars that's legally yours, but you don't have access to it. So you might be getting overdrafts, you might be paying late fees, you might be paying interest on credit card bills because you have that liquidity constraint where you have the money, it's yours, but you can't access it. So we're trying to solve that problem. It's not necessarily an amount of money, it's a timing of money issue. HB 99, sort of as Representative Branning mentioned, we worked on this in 2023. Vermont was one of the first states in the country to take it up. At that time, no other state had passed a bill. Nevada was also working at it on the same time. That bill did pass. Since then, 4 other states have passed similar legislation to this. Wisconsin, Kansas, Missouri, and South Carolina. And California did something similar by regulation. So they did by regulation rather than legislation. And we could talk, I'll try to wrap up a little bit here in a minute. But we could talk about like what's in those states, how they compare, and some other things. But it's basically because Nevada was the first state that regulated this, we've worked with a number of other states to have similar bills so that we do have something pretty similar across states and not a patchwork. So we worked with the Council of State Governments to adopt that as a model bill, and we've tried to pass something similar across the states. There is a federal bill we talked about. It does not have preemption. I think that was your question. So a lot of financial services are regulated on the federal level and on the state level. Ours is similar to that. So there's both federal and state components to it. But the bill, which has passed committee, but it passed committee last Congress, it didn't go any further, but it doesn't have any preemption. It just like would regulate the federal portion, and states would be able to regulate in the state similarly. So what's built into this bill builds on the first time a government took action on what earned wage access is or isn't was in 2017. The Obama CFPB put out a rule on payday loans, basically regulated payday loans across the country. And in there was a section that says, if you follow these criteria, basically no recourse, no reporting to credit bureaus, no mandatory fees, there were a couple other things, then you are essentially exempted from being considered a payday loan and subject to this rule. That was sort of the first time any government had weighed in. The industry was very small then. We're much, much larger now. So they did that. The state of California attempted to do legislation many years ago, did not pass. And so they instead signed memorandums of understanding with us as companies, where basically they said, if you share data with us, we'll take that data and we won't make any regulatory or enforcement decisions while we're sharing that data. That turned into a rulemaking. When we were talking 2 years ago, that rulemaking had just started. And now, almost 2 years later, it goes into effect, I believe, February 15th. So we're but from the first time we started sharing data till the time it actually went into effect, it's like 4 years. So very long rulemaking process in California. So what's in the bill? As we talked about, a lot of consumer protections to ensure that things are in fact non-recourse. I think that's something, I don't know if Ethan and Aaron from the regulator are going to be here tomorrow to talk, but we really worked with them to say like, well, you can't have collections, but does that mean you can do in-house collection? You can't sell it to a debt collector, but does that mean in-house collection? What does that actually mean? Like, what's the difference between customer service and collection? So that's how we got in the weeds on a lot of these things. And that's sort of how a lot of the meat of the bill got processed. That's mostly it. I think maybe the most controversial portion of the bill last time was about tipping as our business model. People were concerned that it wasn't truly voluntary. Traditionally, Earnin has had a user interface where we would suggest a tip. So it would say, if you like this product, please provide us with, please provide us with a voluntary gratuity. That's how we survive. The user interface would be a dial, and that dial would be set to a number that you could either go to 0 or turn it up. The maximum tip we accepted was $13. But we basically agreed, working with a number of folks, that we would not suggest any tips. So our user interface now looks more like what you would see at a coffee shop, where you can pick a number, 0 or a number, to do a tip or a custom tip. And so that was one of the provisions in here, that we could not present a tip as a default option. So any tip you would have to opt into rather than opt out of, which was the old system. So I think that was one thing that when we talked to members of the committee was concerned. And so we want to work with that. There's also some data protection, additional data protection in the bill. One of the concerns that we were trying to address there is that earned wage access could end up being a backdoor way to surveil workers. Rather than an employer saying, yes, we're going to monitor the speed your truck drives, we're going to buy the data from Earnin, and then we're going to monitor you back that way. So just to be clear, Earnin does not sell any data. We do not monetize, to the best of my knowledge. No companies in this business monetize on data in any way, shape, or form. But we put that in there as a safeguard to ensure that didn't happen down the road. All right, maybe I can pause there. Happy to answer questions. I wrote down most of the questions from earlier. I can go through those, or just take questions now. Chairman, do you have a preference?
Why don't you answer the questions that you heard this morning, and then share those questions.
Oh yeah, so we had the question about regulation by DFR. How do we get paid? Was your question also? So yeah, we talked about the two ways we make money are the expedited service fee and the tip. We don't charge any interest. There's no late fees. So the way I like to talk about it is we only get paid if our customers are either choosing our priority services because it's a value that they like, or because they are so thankful that the service is being offered to us that they reward us with a voluntary tip. Many financial services make money when there's something wrong that happens to the customer. It's a late fee, it's interest, overdraft, et cetera. So we think that this aligns our incentives with our customers, which allows us to provide a good customer experience. But that's it. So the margins are very narrow. We only make money if they choose one of those. So many of our customers don't tip us. Many of our customers don't choose that expedited fee. So many of our customers use our service and we make no money on them. In fact, we lose money on them. We lose money on every transaction that somebody doesn't pay us. So the tip, one quick fact about a little less than 50%, about 47% of transactions have a tip. The median tip is 0. The average tip is like $1.12 or something like that. So on average, say the people that are tipping, the tip is like $1. So that provides you an order of magnitude of sort of what we're talking about here. On average, with the fee, with the tip, everything, your average transaction is going to be about $4 or $5. You asked, I believe, sorry.
Clarify on how much money?
Yeah. So our average transaction is like $100. So you can access up to $150 per day and up to $750 per pay period. Every company has different limits. Those are our limits. But the average that people take out is 100. According to the law, either type of business could solicit a tip. But right now, of the companies that solicit a tip, only the direct-to-consumer companies solicit tips. There's us and a couple others. Let's see. Yeah, can you be terminated if the tip is not paid? No, the service is paused. So and this is actually a good question. What happens if you don't get paid back? So let's say on Monday, you access your wages on Monday, you get your $100. Friday comes around and you need your full paycheck. You can contact us and say, please don't take it out of my account this pay period. Take it out next pay period. You have to do that 3 days ahead because of the way that the ACH clearinghouse works. We basically have to tell ACH 3 days ahead to not take the money out in order for it not to come out. But you can do that. There's no cost to that. But you cannot take out any additional advances until that gets paid back. So that's risk management both for us and for our customers. So they can't continue to accrue money that is then owed later. They can also just say, don't take this money out of my account ever. Say, Earnin, I withdraw my authorization. Do not take this money out. We don't take the money out. They can't use the service, so they can't accrue new advances, but they're just paused and they don't use it anymore. Things that happen, like what's a use case where this happens? Well, somebody takes the money out, they're just having a really hard time. So they either just don't pay us back, they close their account, or they tell us don't take it out. And so they're paused of the service. 6 months later, they're back on their feet. They really like the service when they used it before. So often they'll come back and say, okay, Earnin, here's your $100 back. I'd like to use the service again. They can come back onto the service as if they never left. They don't pay any extra. They pay that original $100 that they were advanced, and then they can use it again. This is credit invisible. So we don't base any of the scores on base any of the access on credit scores. So if you're a new immigrant into the United States, you have no credit history, you can use this just like anybody else. The fees don't change based on credit scores. So it's like an ATM fee, stays the same for everybody. And if you don't pay it back, there's no negative implications for your credit score. The only recourse to you, and this goes back to the payday rule exemption, you cannot report to a credit bureau. So you're basically, the only recourse against you is that you can't use the product anymore. And even other Earnin products that we offer, you can use those, you just can't get the advance from us. But you can use our, we have free credit monitoring, we have a savings account that people can use. And so you can still use those other services. All right, federal preemption, we talked about that. My understanding is that the Chevron decision would not have any implication on state rulemaking. And even as a legislature, you could tell your regulator to make a rulemaking, and that wouldn't, it's really only rulemakings that are taken on without the express written direction of the legislation. So wouldn't have any impact. And then the last question was about if you can operate. It is pretty common for an application period and then a grace period while the application is being processed. I don't know the time period that's normal in Vermont, but the first two states that required EWA licenses were Nevada and Missouri. Missouri had their application up within 45 days. We got approval within like 2 weeks. Nevada took like a year and a half to get their license up, and the process took many, many months. So every state's a little bit different, but it is pretty normal to say that, you put your application in and then you can operate while that's processing. Sometimes you have to change things a little bit, but that's a normal course. So, okay, those were my notes for the questions that maybe you guys had for us, but I'm happy to take any other questions.
Thanks, man. And I really appreciate you addressing like the tipping, the default tipping piece. I'm gonna ask questions based on something the CFPB reports I just
Yes.
had yesterday, which were not when we talked, I had not seen them, so I apologize for.
Yeah.
But so director in July
Yeah.
says the proposal at the time makes clear that if workers obtain money that they are required to repay through a paycheck deduction, that's a loan under existing federal law. This means that lenders must disclose an accurate interest rate in accordance with longstanding rules covering loans. I'm just like curious response to.
Yeah, absolutely. Yeah, great. Yeah, so so that was a proposed rule, is not finalized, it's not non-binding. We provided a very long and extensive comment, which I would be happy to provide to you that we think that why we disagree. Ours was, I think, 30 pages long. I will make a note here to send it to you. Part of the reason why we're here asking you guys for clarity is that, in the now almost 8 years since the CFPB put out its first guidance on us, every few years the guidance changes, and it's very hard to grow a business under those circumstances. So, we got one set of guidance that said this, we got another set of guidance that said this, and then that was repealed. And so now this guidance comes out, which again is non-binding and not finalized. So we're under this like very nebulous situation, which is one reason why we're coming to legislatures and asking for certainty. Send comment letter. Okay. Happy to go more in depth on that or ask any other questions.
When you send it, you just send it to Anna Grace and then
Sure. Yep. All right, great.
post it on our webpage as well.
Yep. Great.
That's sort of a business operations question.
Yep.
If a consumer comes to you and says, I'd like $100 advance, do you have a process where you're kind of?
How do we verify the wages? What's the flow of funds? Yes, exactly.
Thank you.
Yeah, absolutely. A very, very common question. I meant to cover this in my testimony. I forgot. Okay, so I read your bio. I understand you own a small food service company. So your employees could absolutely use us. So they would download the app. They would connect their bank account to us using a service called Plaid. That gives us read-only access into their bank account. A lot of companies use that. We would use that to verify that they've gotten a paycheck, and they would say, okay, you've gotten paid between $900 and $1,100 every 2 weeks for the last 16 weeks. So we know on average that you make about $1,000 every 2 weeks. Now, for a company like a catering company where you're working at different places, that's going to be a different verification than somebody that's going to an office every day. If you're a traveling nurse, if you have a work email address, if you don't have a work email address. So we have various different options in the app that the worker will choose based on their employment situation on how they can verify those wages. They choose that so that we can do it. So essentially we'll do that. We use their net wages. So whatever their deductions are, it's net wages after that. Generally, we'll start them out with a small amount, let's say $100 per pay period. That's good risk management for both of us. If they use that, we get paid back. Then the next time, maybe they'll get $200. And so it'll work its way up to that $750. So you as a business owner would not have any impact. We have businesses that offer this. They put an earn-in advertisement in their break room that says, hey, if you need this. I was having a conversation like this in the state of Wisconsin. The speaker owns a small manufacturing company. So he did this out of his pocket, right? So he gave $100 to his workers out of his pocket. That's how Earnin was founded. Our CEO was the CEO of another company, and he basically would just do this out of his pocket. Workers would come in and say, "Hey, I need an advance on my paycheck." He'd give them $100. He sold that company. One of his workers said, "Hey, I like that. Will you still do it?" A little light went on his head. Earnin was born. Sorry, that was a longer question than you were asking.
Just a little clarification, because I mean, I definitely see the value, and I've given lots of advances over the years. And, but there's a lot of companies, I mean, catering is one, there's a lot of others where it's sort of like, I mean, they're an employee, but they're gig workers.
Yes.
So their revenue, their income varies widely.
Yep.
And a lot of those people are like, like, oh, I want to work a whole bunch
Yep. So,
right now.
So Earnin, so Ryan's business, I know works with some independent contractors. Earnin typically only does W-2 employees. It does not work as well with independent contractors. We have some, but mostly not. And one of the reasons is if you're an independent contractor, if you drive Uber, if you drive something else, you can get that. Like if you drive Uber, you can get paid after every single trip. You hit a button, you made that $20 on that trip, you hit that. If you're a W-2 employee and you work an extra shift, you take an extra job that you don't have to take, you might not get paid for 2 or 3 weeks. So like thinking about like restaurant service, front of the house, back of the house, if you're a server, you can take home cash every day. If you're a dishwasher and you take an extra shift, you might not take that. You might not get paid back for 3 weeks. Same thing with a lot of, so the partnerships we have are like with Walgreens, Home Depot. They're competing for talent with those independent contractor companies. Some people want the stability of W-2 that comes with benefits, that comes with other things, but they want the flexibility of being able to get paid. It's an on-demand world. That's what people expect these days. And so earned wage access allows them to both have the stability of the W-2 employment relationship and the flexibility to get paid on demand that they might get in some of those more flexible roles.
And actually, Ben, when you answer this, I'm just curious, like I know Earnin is one of kind of the players in this space. So
Yeah.
also like just concerned for if this question covers all of like,
Yeah,
your
of course.
knowledge.
Yeah.
When employers are using the employment version, like are they getting a kickback? That could like I guess my question is going to if they are getting kickbacks,
Yeah.
then are we kind of like setting them up
Yeah.
to enable like basically employees to
I'm pretty sure it's in here. If it's not in here, it's part of our model bill that you cannot give any kickback to the employer. And the idea is you don't want to incentivize that employer to try to do something that gets them paid back.
Yeah, okay, all right.
Emily?
How many, like for Earnin, I guess specifically, how many folks that use the free version find their way into your paid services?
Yeah, I would say some people never pay anything. Like it's about 11%, 12% that always take the free option no matter what. Most people do both. Sometimes they take the free option, sometimes they take the paid option. And so just like a use case, on Fridays, we see a lot more people take the paid option because they want that money right now for the weekend. At the end of the month, we see a lot of people using the free option because they know rent is going to be due. So on the 28th, 29th, they take out in advance, knowing that that money will be there by the time that comes.
So I guess actually also and additionally, like just looking on your website, you seem to have a number of other paid options and services. How do they find their way to your other products?
Yeah.
Or-
So
I'm looking, all right, so you have the cash out service, which
Yeah.
is partly
Yeah.
the
Yeah,
either paid or not.
Exactly.
And then you have
early pay.
early pay, which
Yeah.
is sort of similar, but not exactly the
Yeah.
same. And so do they find their way into that? And then I'm also like the balance shield, the tip yourself,
Yeah.
credit monitoring, which I'm guessing is also a free service to some
Yeah.
degree. So do
Yeah. Happy to walk through all of those.
do they find their way from just starting at this free service into all of these other
Yeah.
services?
Tip Yourself is also free. That is a savings account. So it acts a little bit like a layaway where you can put a portion of each paycheck in there. There's no cost for that. So people use it as a savings. About 15% of our customers use that. The early pay feature is pretty new. We only started it a couple months ago. So a pretty small portion, only maybe, I think, a couple percentage points of people use that. And that's essentially where you get your entire paycheck when the ACH file gets sent rather than settled. So you basically get your full paycheck on like Wednesday instead of Friday. It's not always that, but that's basically that. Again, it's a pretty small percentage that use it. The vast majority of people use the cash out. Yeah, and credit monitoring is free also.
Okay, and then so you're saying that about 11% of the people consistently are using the free version of that?
Yeah.
And so the remaining folks are using the paid version.
Yeah, they go both ways, yeah.
It fluctuates.
Mhm. Yeah, so every time you can choose which option for every advance. There's one other thing I want to say that I forgot. Oh yeah, Balance Shield you asked about. So Balance Shield is essentially just it's also free. And the way it works is you set a limit on your bank account. So like if my bank account drops below $200, send me a notification. So we send that notification, hey, you're low, so you don't get an overdraft. You can also set that so that if it is below $200, you'll automatically do a cash out. So you'll send, $50 or $100, whatever you set into your bank account. And that has that same free or paid option. So you can send it over ACH for free, or you can send it immediately for the paid option.
Do you have a sense of the conversion rate from the free products into your other services?
I don't. But maybe I'd be happy to maybe talk more, go more in depth on it. Yeah, sure.
Thank you. Appreciate the detail and appreciate the modification since the last time you were here. Question around the 4 times going into somebody's bank account for repayment.
Yeah.
And you had just previously spoken about the fact that if they owe you money and they just can't use the services. Talk about.
Yeah.
I have lots of questions about the 4 times, but let's start.
Sure. Yeah. So look, we have, you authorize us to deduct an amount from your bank account. There's a federal law called the Electronic Funds Transaction Act that all of those transactions are regulated under. It's the same as Netflix or utility bill, et cetera. We will attempt to be repaid on your paycheck. Again, if that doesn't happen and you don't withdraw the authorization, we will attempt to get the money on your next paycheck. And so that's what that four times number is. Also, it's both us and the and the business to business. When we first wrote it, sometimes a company might not make payroll, or they might estimate a wage of one thing and then it's less, so you might not be able to get paid back. So the idea was to have some parity between the number of times you could get paid back. But yeah, that's basically it. So if it fails, we are allowed to retry to get paid again.
Unless they withdraw.
Correct.
And 4 times?
I don't remember exactly how we decided on 4 times, to be honest with you. It's actually the way that getting into the weeds here. The way that there's two different repayment mechanisms. ACH, which is essentially goes back to writing a check days, and then there's Visa. ACH is what typically might draw an overdraft if your bank charges those. We don't get any money from overdrafts. We try to minimize those. It's a bad customer experience and we get no benefit. So we do everything we can to do that. We typically will only do 1 or maybe 2 ACH repayment effects. Then we'll use debit. There's no downside risk to the customer if we attempt a debit transaction. It basically just comes back declined and says no. So there's no, they wouldn't even know. No overdraft fees for those. So basically we'll ping the bank account. If they have the money in there, we'll withdraw it. But if not, nothing happens.
So 4 isn't necessarily a magic number. 2 is likely an acceptable number, but we can look into that farther and figure out.
Yes. It
feels excessive.
Yeah. I agree. Happy to talk about that. I think here is a policy question for you guys as policymakers to consider, right? Everybody that doesn't pay us back that $100, everybody else has to make up for that, right? Because we absorb that loss, and in order to continue to provide service, we have to make up for that loss somewhere, right? So I think there's a balance of how do we get paid back to ensure that our service is sustainable with how do you treat people with dignity upon those repayment methods. Sure.
Jim?
Ben, you were mentioning the California rulemaking. I'm just curious, are there other additional safeguards since they have been doing their rulemaking that we do not have in here.
Yeah, I mean, to be honest with you, the California is a kind of an interesting rulemaking. Essentially what California said is that we consider you a loan, but we're exempting you from our loan laws if you register under this other bill, which is they have three main financial protection rules. The CCFPL, which is the California Consumer Financial Protection Law, which is essentially a catch-all for anybody that's not a loan. Then they have the Consumer Financing Law, which is a lending law. And then they have the California Deferred Deposit Transaction Law, which is basically their payday loan law. They said that we think you fall under the CFL, the California Financing Law, but we recognize that you are different. And therefore, if you register with us under the CCFPL, we will exempt you from the requirements of the CFL. There are not, to answer your original question shortly, there are not any other additional consumer protections in California that are not here. I think maybe just one thing, and California, we do share data with California. This draft does not specify what, it does say that the commissioner can ask us for data, but it doesn't specify that. But California does say what data we can share. And we share that with a number of other states as well.
One more for now. I'm just curious, when we say that it's not non-recourse, but you have ongoing access to people's accounts, how does that reconcile?
Yeah, so each transaction has to be authorized, right? So if you authorize this $100 today, we are authorized for that $100, but we're not authorized for anything else beyond that. So if you authorize Netflix to deduct $14.99 a month out of your account, they have access to your account over the whole time, but they can't do anything other than that $14.99. So that's the same with us.
Is that true of all businesses operating in the space, or is that an earn-in specific?
So the way that the business-to-business companies get paid back is a little bit different. They're generally going to get their money directly from the employers, so it's a little bit different. But for direct-to-consumer companies, it's the same because that's a federal law. So anybody that accesses a bank account has to abide by the same federal laws, and so we are treated the same way as anybody else. We don't get any special access that any other businesses that debit accounts have.
When you mentioned earlier on the tipping that it's just like it is on a restaurant receipt.
Yeah.
Does it show the percent?
Well, on a screen, yeah. So the way we have a couple different.
If I got $100.
Yeah.
Really easy. And I wanted to tip you $5. Would it tell me?
Yeah, it would, we don't use percentages, we use dollar amounts. But yeah, it would say like, there'll be four bubbles, it'd be like 0 or 246 custom 0. So if you want to do 5 and we suggest 246, you would hit custom, and then the next screen you would pick 5.
And then in that case, are the transactions like sent to the consumer in like an email or?
Yeah, exactly. Yeah.
It's outside.
Yeah. And so that's in here that you have to notify. So yeah, so we'll send you an email that says, congratulations, you have $100 coming your way. Your next paycheck is on, February 14th. We'll deduct this $100. If you have any issues, here's a 24/7 customer service. Please reach out to us.
And then do you break out that number amount because of how much you spent to send it out? Or?
Yes, that will have like, it'll say like $100 advance, $3.99 fee, $1 tip.
I lied up one more. It looks like just looking at the California stuff, it looks like it's what an APR. If you had an APR, it would be like 330%. So I mean, it exceeds Vermont. So like, we don't have a cap in this, right? So should we be considering a cap as a cap?
Yeah. So look, we think that APR number is high based on our numbers. The APR number is skewed based on, the very short length of time of these transactions. So if I give you $100 and you give me $101 back the next day, that's a 365% APR, even though it's a very low amount. The way APR is calculated on the federal level is different for different products. So like if you're a credit card, the APR that is disclosed is only on the carried balance of your amount. So if you pay a fee for a credit card, that's not converted into an APR. So that's an open-ended line of credit. So when you see a 36% APR credit card, even if you pay a $10 fee, which most credit cards cost $10 for a cash advance minimum, that doesn't change your APR at all. You're still 36% APR. If you're a closed-end loan, then APR is calculated on mandatory fees. So basically something that is required as part of a loan, interest, et cetera, it's included. Optional things that are not, quote, imposed are not included in that APR cap. So when you talk about APR things, it gets very complicated, very quickly. We think that the industry is very competitive. We not only have to compete with each other, but we have to compete with a free option, right? So 1 to 2 business days is not that long to wait. People may pay $4, they're not going to pay $10. And so we think that there's a lot of competition that's built in there. No state have passed a fee limit yet. Some are considering it. I think that would be a policy question for you. You know, as a business, I think our preference would certainly not to have a fee cap, but again, as a policymakers, I think that would be your guys' decision.
When you talk about
Yes.
go into that a little bit.
Yeah, sure. So, so this is, again, it is a savings account.
Interest-bearing?
It is not interest bearing. The amounts in there are typically very small. I think the average balance is like $200. So essentially we have a partner bank. This is a normal bank account. It's every account is an FDIC insured account. It's its own individual account. It does not bear interest, but there's no cost to the consumer to use. You can transfer your money out at any time. Yeah, I think the idea is it's convenient. And a lot of folks don't have great banking options. Like a lot of banks have minimum thresholds and whatnot. We have a partnership with a large big box retailer. They have over 25,000 employees that still get paper checks because they don't have bank accounts. So there's just a lot of folks that the convenience of it is easy.
So is that then the first source of funds the next time a person who has that $200 account?
Yeah.
If they put in a request, or do they have that option?
No,
that they can
it's the
ask for
option.
that money
It's the option. So
rather than get the advance?
What a lot of our customers do, they like to keep it separate. Like they feel like dipping into their savings for normal everyday expenses is something they don't want to do. So they keep that savings for a true emergency, and for everyday life, they use the cash out product. So they're completely independent. Let's say you don't pay us back, but you have money in that tip yourself account. We can't go after that money. That's not, so that doesn't, the walls never cross there, or the lines never cross.
And is there any particular reason why that savings account is not interest bearing?
Sorry. I don't know the answer to that. Up until very recently, essentially no, the interest rates were very, very low. And so for much of our history, there just wasn't, a lot of interest to give. I think there's conversations on potentially doing that, but it just has never been an interest bearing account. Sure.
How do you serve people who are unbanked?
So the two requirements for earn-in are that you have to have a direct deposit and you have to have a bank account.
Like the debit card, sometimes people get paid directly on a debit card.
Yeah, that we would not be able to do that. We are working on a product that basically we would give them an account. It's in beta testing right now. We have a couple thousand people across the country that are on that. We hope that later this year we'll be able to roll that out, but right now it's only in testing.
Is that the Evolve Bank and Trust, or what?
Well, Evolve Bank and Trust is our partner bank. So they do, they are the ones, like the tip yourself is an account at Evolve, but we're the user interface.
Okay.
And so like the early pay, Evolve facilitates that.
Okay, so for this advancing product, do your customers have to sign up for an Evolve account
For the basic service, they do not have to sign up for an Evolve account.
but for the paid service, do they?
Not for the lightning speed, the only like if they do the tip yourself or the other things.
Or the other things.
But not for the basic cash out.
Thank you.
That's my question for, if you have a question.
I don't know, he may have answered it, so go for it. Like,
So talk to me about how, without being a bank, how these earned wage access services should be considered financial institutions.
Yeah, so I think that's a great question. That part of the bill did not come from us, to my knowledge. You know, I'm not familiar with Vermont's banking law broadly. Generally, what a lot of states have is they sort of have financial institutions, which are banks and credit unions. They have lenders, and then they have everybody else, and there's sort of three buckets. And we have been put in the everybody else bucket. That could be, you know, money transmitters, you know, mortgage brokers, other financial services that aren't specific to that. In reading through this, there are those other services included in financial institutions. I think, again, that's a policy question that I would, you know, I don't know that
You
it
can't answer that.
exactly. Yeah.
I'll keep pushing on it. Thank you.
Conversation with DFR. Anybody else?
yeah, or you only do business with American-based base.
Yeah, we're 100% domestic. Yeah.
Ben, thank you.
Thank you very much.
Ryan. Please joining you as well.
No, just me. Yes. So, Mr. Chair and members of the committee, my name is Ryan Naples and I'm from Daily Pay and I'm testifying in support of House Bill 99, just like Ben. And Daily Pay is the country's largest business to business or employer integrated earned wage access company. We partner directly with employers in Vermont. Since 2015, we've partnered with over 126 businesses to provide over 8,000 of their employees the option to access our service. Some of our top employers include Target, WellPath Health, Hyatt, the dairy farmers of Vermont, as well as Easter Seals. We are a low-cost alternative, and employees use us for one very specific reason, they tell us. It's because we're a low-cost or no-cost option for accessing liquidity quickly. We do solve for a frequency of pay problem, not for income insufficiency. The more specifically about the way that we operate is we sign contracts with our clients who are businesses, and we integrate with payroll and time and attendance systems. It usually takes between 4 to 6 weeks unless they already use ADP. We have something called a white label agreement. So ADP is already connected to us directly. So it goes almost instantaneously if they are an ADP client. Once we do that connection, all of the business eligible employees are able to download our app. So for those who do, we pull their net earnings 4 times a day from our partnerships. And then employees, if they choose, can access their own earned pay before payday based on what they see on the app, that, you know, based on those verified wages that they've actually earned. So not everyone eligible to download our app actually do so. Only about 36% of Daily Pay's clients, employees actually do. So again, this is like an entirely voluntary service. Our app includes a host of financial wellness tools, including access to a free nonprofit counseling and financial education services through a partnership with a nonprofit called the Coordinated Assistance Network, which is based in Florida. So it's an entirely Zoom service. But about 49% of people on our platform will just track their net wages as they earn them and never make a transfer. The other 51% who do choose to pay themselves access an average of $148 per transfer per user in Vermont. Almost all EWA companies like share a few key characteristics. Like our business model is very different from earn-ins, from Ben's, but we are all just like where I work, credit invisible. We charge no origination fees, late fees, or interest. We do not sell unsettled EWA debt and conduct no underwriting, but set-based access on wages earned. Most providers offer instant delivery of earned wages to a bank account for a flat one-time fee of around $3 or at no cost. A no-cost transfer typically taking 1 to 3 business days. Daily Pay instant fee where I work is $3.49. An instant transfer at no cost to an EWA's company's debit card is also common. That is an option that's available to people who are unbanked because we have a general purpose reloadable card. when users do choose to download our app to access their already earned wages, they're not doing it in a vacuum. And so the research that I've submitted to the committee really shows how we are an alternative to $35 bank overdraft fees, credit card late fees, and how we are saving people money. In all cases, really, the alternative to EWA is more expensive than $3.50 or no cost. So the independent research from 2021 specifically found that people, 78% of our users had previously paid bills late and then no longer did so after gaining access to Daily Pay. Our research that we sponsored in 2023, but with the Financial Health Network, also kind of showed very similar findings that people use EWA to pay bills, do ahead of their paycheck, and that users didn't consider it a loan, and that they really this helps them really preserve people's dignity also. We do think EWA is working. I think you might hear later about the frequency of use, and I think people will testify later about their concerns with the frequency of use. I do want to address how we do help people get out of debt. So from June to December of 2024, we did closely track our high frequency users. Our data showed an 80% decline in high frequency usage of our platform after 4 weeks, a 92% decline by week 8, and within 12 weeks for 3 months, a 96% decline in high frequency usage. So that nets out to less than 1% of all people total on our platform being high frequency users for 3 months. I think as a product and industry creator to help solve financial instability, we do take accusations that our product could be radically abused or misused very seriously. Clearly, I think a small number of people use our platform frequently when they have an emergency because it is a low cost or no cost alternative to all other options. Because EWA isn't credit, and especially with Daily Pay, the available credit balance is based on verified wages, and that's information pulled 4 times a day. So again, because we're not a credit product, we don't underwrite, we don't base the transaction fees, the transaction fee on creditworthiness, and we also don't charge the $3.50 one-time transaction fee for instant transfer in installments, which is again, it's another way that we're very different from an actual loan. Going to APR, this is why we do think that HB 99 does regulate EWA the right way. An annual percentage rate attached to a fee this low would really would have a misleadingly high number attached to it. I think Ben kind of touched on that. I think it's why we at Daily Pay agree that regulating EWA the way HB 99 is proposing makes the most sense. You might also hear later about how Connecticut has a different rule for EWA, but Daily Pay users have told us that they are worse off since Connecticut's decision to make EWA a loan in September of 2023. Specifically, since making EWA a loan there, 87% of Daily Pay users in Connecticut responded to an in-app survey in April of 2024, saying that they now paid more in late fees on bills, overdraft fees, increased credit card interest charges, and more late fees on loans. I think notably, no other state and the Biden administration also did not follow Connecticut's lead. Instead, 6 states, including California, as Ben talked about, chosen to not require EWA to obtain a lending license and instead found a way to regulate EWA in its own unique way. Specifically, you did hear about California, and in 2020, EWA providers started submitting transaction level data and consumer complaint resolution information every fiscal quarter starting in 2020. And again, after receiving and analyzing this information, California did choose to impose no requirements that are required from lenders in the state, including no fee or usage limits on EWA products, despite being within their authority to do so. So while EWA is classified as a loan under California law, the finalized rule does not require a lending license, which is why California required no change to business operations. So I do think it was obviously a compromise, right? Because the way you would define it is we are a non-licensed loan in the state of California. I do think it's an important almost starting point that HB 99 really builds on, with additional protections above what's required in California. I think the biometric data ban, the sale and the usage of biometric data, the fact that it's a ban instead of the ability to ask for affirmative consent to use it, which is so the ban on the sale of biometric data is a very strong consumer protection that is not in the California rule. So this does go further than California for sure, which is, I think, something that's important and something that we do support. At the federal level, as referenced as well, the Biden administration did propose a rule in July 2024 to regulate EWA as a loan under federal law. That proposed rule was not finalized, so EWA is not a loan under federal law, just like it would not be a loan under Vermont law with HB 99. So by proposing and abandoning this rulemaking, this was the only such proposal the Biden administration's federal regulator started and did not finalize. So this move, we do think, is representative of conversations with policymakers really all over the country that regulating EWA is complicated and it requires time and thought, careful consideration of unintended consequences because of the alternatives to our products. Something that I think that this committee has really worked on in working on this bill over the last 2 years. But simply put, like, there is no silver bullet to regulating EWA, and making EWA alone without bespoke consumer protections is a simplistic solution that leads to EWA companies not being able to operate and people just being worse off. So this is really why Daily Pay is supportive of HB 99. And we look forward to working together with all of you. And I'm happy to take any questions. I do want to maybe answer 2 questions that came up. So first, the employers do never get a kickback on any of the fees that we receive. And in terms of the 300% APR number from California, it follows us everywhere. In terms of their methodology, in 2021, when they did the calculations, they did not include any of the free transfers in their calculation. So we really did push back, telling them that their methodology was flawed because they were not including those $0 transfers. Second, they used 5 companies for that calculation. They used 3 companies that asked for tips and only 2 companies that did not. At that time, there were 3 companies that asked for tips and 25 that didn't. So if you were going to include the 3 companies, we told them, that asked for tips, the methodology would require you to then include all 25 information from all 25 companies that did not ask. Otherwise, you're overweighting the amount that people charge at the tip companies. They were like, okay, great. They were like, thank you for your feedback, and that was it. But I think that's partly why the APR question is a complicated one. And we do still think that like having the actual fee amount disclosed is really important, which I think this bill does. So happy to take any other questions.
Thank you. I'm just curious what percentage of users are actually opting in for the subscription, and I don't know what the cost of a monthly subscription tends to be.
We don't have a monthly subscription.
Okay.
Yeah, there's another company, but there's maybe a couple of others that do, but we don't. Yeah.
Okay.
We just have if you want to transfer your wages instantly to an external bank account, then there's it's like PayPal or Venmo.
Yeah.
So I'm looking at one of the slides that you
Yes.
provided for us, and it says that you don't charge the employer fee.
Right.
So they don't contract with you, the employer doesn't pay.
They contract with us to allow, and they vet us like crazy to allow us inside their payroll and time and attendance systems. But no, we don't charge them a fee for offering the service to their employees. I think there was a time when it used to be. So in 2021, this industry got really competitive, and I think we might have been the last people to charge a fee, and then we stopped doing it to the employer because everybody else was not. So that's like kind of just how things have evolved.
How are you making?
On the $3.49 transfer fee. We're in all 50 states, right? So we've got 2 million people on our platform. And there was a time when we only sought out large employers. And now we also do smaller and mid-sized businesses. I mean, the industry we were started in 2015, but the industry started growing in 2017 when Walmart and Target put out an RFP asking for a digital service like this, because at that point their general managers were still keeping track of who was getting an advance early on like a notepad. So that's with paper and pen. So yeah, that's how we make money. We do make money on the swipe too of our debit card. So just the way like any other credit card does, like we make it on the employee doesn't pay anything. It's the business paying it. It's like 3% or something of whatever the charge is. interchange is what's called.
Taylor gets to pay it.
The retailer, unfortunately, yes. Sorry.
That's for full disclosure, on kind of convenient.
Right, no, I do. You only get half of that 3%, I believe. That is our deal. We only get 1.5.
Questions?
I'm just curious about like it's the especially like repeat people who are actually like starting to be if they become like reliant or dependent on this. Like so in the way I was asking about like a potential cap on fees. Like I'm just curious about if there's been any discussion on a potential cap for the number of times like per month or per year somebody's doing this so that they're not like paying it off and then immediately taking out another one. And just instead of learning financial literacy, they're like dependent on this.
Yeah, I think the reason why California didn't do that, the reason why, it is an important thing to think about, short-term, long-term consequences is the usage that we at least see on our app is not long-term. The fact that 80% of people are not high frequency users after 1 month, we think is a very different kind of life cycle of someone who's in like a debt spiral, really, even with a credit card, which I think is which is the really like the debt trap that is most common in the United States. And we are so far removed from a credit card. And in fact, we're actually seen more as like the solution to how people can not pay the credit card minimum late, as opposed to not having access to any liquidity to do it. I do think that, it's been talked about a lot. I think it was first proposed in New Jersey in 2021, a frequency cap. And because we all have a no cost option, I think that's why it was bounced out of the bill. I think the frequency cap was discussed also in Nevada and in a couple of other states. And it is always weighing EWA, not in a vacuum, but against what is the person doing instead, right? And there's really just no other alternative. So I do think there are other things besides capping frequency that is possible for high frequency users. Things like, we do offer, we're the largest in the country. It's easy for me to say every EWA company should have a nonprofit that offers free counseling and coaching. So it's easy for me to say that because we already do that. But things like, affirmative consent, that they know that they're actually doing the more than 4 in a month, or just like an alert that they're doing it. I think there are ways to make sure that there are protections for people who are using it frequently that isn't just like capping access, which then just leads to more expensive alternatives, to be honest. Yeah. And I also do think we're not in hiding, right? Like we've been in conversations with regulators, with legislators really since 2019, and with the ones that are kind of like the most groundbreaking and like want to do things big and bold. And, that hasn't happened yet because of the understanding that, when we go away and when someone can't do the fifth time, that fifth time costs far more than $3.50. Hi.
Hi, I'm Lee Paris, Wilmington, Medina.
Nice to meet you.
Nice to meet you. The question about the counseling, has that always been a part of the product?
So for us, yeah, I mean, somehow we got lucky, and when we were starting, our founder and former CEO created a partnership with CFA, the Consumer Federation of America, and through CFA, we had a partnership with America Saves, which is an organization like an offshoot, and through them, they introduced us to the Coordinated Assistance Network, and that's how like our partnership kind of started. And to be honest, when we were a startup, CFA covered the cost for our business. So it didn't even cost us anything. And now that we're able to pay for it instead of CFA covering it, that we do that.
And are you finding that there is an uptake for consumers that are using the EWA platform for the credit counseling? Like you said that some of your most frequent users were managing to convert themselves to paying on time.
Yeah.
They also using the credit or the counseling services in conjunction.
The counseling services folks have told us that they see mostly, they'll see usually the people are around age 30 and rarely over 35. And it's usually either people who are in a bad place with credit cards and don't know where to go and what to do. And in that case, our counseling people usually refer them to like a debt management nonprofit. And then the other people that are coming are people that are very responsible and are saving for like a bigger purchase. So the access is important to keep people afloat, but I think when they find themselves coming to see us to CAN, they're coming for like one of those two like primary reasons is what it sounds like.
So are you tracking the usage of the EWA product with the people that are seeking counseling?
No, we're not. We're a data minimalization company, I think. So anytime we do any sort of new data, so we didn't even ask for zip codes of where our people lived until I think 2021 until 2020 when California required us to start reporting information to them. So I think we do have address now, but we don't even know who it is that's getting the counseling. We get anonymized feedback, which I think is like standard in like the industry to not give.
Yeah.
Yeah.
Like they're
Right. Yeah.
Having a sense of like the.
Yeah. Sometimes employers will come to us and say they want that information and because they want people to use the counseling services that they contract with, especially Target, I think. And, we tell them like, it's not up to us. Like, it's up to you guys, up to Target to determine, to get your own employees to go to the counseling services that they want.
So just to stay on that, do
Yeah.
you know what percentage of people that use your product actually ask for counseling services?
I can find out. I don't know that number off the top of my head. Write down. Go for it.
Two studies you've referenced in your presentation, were those fully randomized of users, or were that a select group that you'd sort of?
Right. In 2021, it was, I think, the economist who ran it had a way of, I think it was like, she emailed everybody on our platform and the first 10,000 users were the people that she spoke with. And then in 2023, we were far more removed. It was the Financial Health Network went and found people who used in any EWA product, like the way you find like a focus group. And so that's how they were, I would say, randomized. Yeah. And that's how they got their information.
The second one appeared to be about 10,200. The first one's about 1,100. Was that just over 2 years, a lot of growth, or is it just more going into trying to reach a broader range of your customers?
Yeah, it was a broader range of the customers. Yeah. Yeah.
What point do you have access to companies' employees' financial records?
So we know when they are working, right? And we know their tax and benefit elections. So we know anything that their payroll provider knows. So we don't have access to like their bank accounts. We don't have access to
You have access to their records through that company without their consent?
No. So you do have to affirmatively consent to download our app, and there's like
Prior to that, so you have this relationship with the business,
Mhm.
and they're giving you access to their, say it's ADP.
Mhm.
So do you have access to individual employees' records
Mhm.
at that point, or only after they have downloaded the app?
Right. So yeah, it's only after they've downloaded the app. So we sign an agreement and we hope people will download the app and use it. But if no one does, then we do not get access to anything. There's, the payroll time and attendance connection is there, but we only pull information once someone actually downloads our app.
Do they provide you like an aggregate of what their total payroll is or anything like that to give?
No, it mirrors the data exactly. So it's the same way, it's all the same information that a payroll processor would have throughout the day. So there's really no like difference between us and the payroll provider in terms of what data we get to see. I mean, it's for salaried employees, it's really just like a math equation. It's for the hourly employees that the calculations are important. Yeah.
I just want to be sure that you don't have, or you're not gaining access through a payroll company because they have access to all of that information, and that they're not providing that to anyone else without the express consent of the individual employees.
Right. Yeah. We only get the payroll information once someone actually agrees to sign up. Yeah.
Yeah, that was my question. So
Yeah.
you can't see, actually, there's certain questions. Let's say I download the app and then you can access my information. Can you access historical information?
No.
Right, and you can't access any other employees in that company.
Unless they're saying, unless they want
Each
it.
employee has to.
Right. Yeah.
Okay.
Yeah. And we don't even keep it on our system. I think it's like, I think whatever California's privacy law requires is what we have enacted all over the country, which is why,
See.
similar to Ben's product, people can disappear from us and they can ask for their data to be deleted. And then, the only recourse is that they're frozen on our platform until they decide to come back. And that is like the way that we do kind of settle the EWA amount is through the payroll process. So we get the entirety of the paycheck. We then send the remainder pay to the employee directly. So we never see the inside of their bank account. We're just sending money to it. And then we do have a number of independent contractors on our platform. We have for a while a number of hospital systems that we have pay a large number of their nurses as independent contractors. I didn't know. And that's the bulk of our independent contractors are those. I think they're like on-call nurses is what they're called. And I think we used to have DoorDash, but I'm not sure if we do anymore. No.
Questions?
Yeah, so I also just noticed that you have a small business product too.
Yes.
So this works exactly in the same way as the
Right.
larger over 500 employee product.
Right.
Okay. And then are you also, and so you're getting,
Like, how does it all work? No idea. No, I'm just kidding.
No.
I think we're on an HR tech platform. So apparently there are platforms that if you own a small business, you can go, and you can just choose a number of different things to offer your employees. And that's, I think WorkJam is the name of the adorable company that we partner with the most, that has us as an integrated service.
so explain to me how that works with the whole connection with ADP and all of that.
Well, yeah, ADP I think is separate, and they're the big dog that is different from companies that do their own payroll. When we do partner with a small business or medium-sized business, we do have to manually, even though it's digital, like manually connect with however they are keeping track of time and attendance and benefit and tax elections. So it is just more time intensive as opposed to the larger payroll companies and the larger companies that everything is like almost like an instantaneous connection.
Mhm.
The real delay in the instantaneous connection for the bigger organizations is the vetting that goes back and forth because they don't want to give us access to their system until they're really sure that we are safe. And similarly, like we do not want to connect our own company to their own company's payroll information systems until we're also satisfied that it's not that it's properly secured against hackers, to be honest. Yeah.
So are you, with the small business package, are you using this intermediary company to do that security work for you? So the small business is tying on to, what was it called?
WorkJam.
So they're tying on to WorkJam.
I think it's part of it. I think we still do our own vetting. I think it's pretty standard for us that it still takes 4 to 6 weeks for connection unless it's coming directly through ADP, just because of it's very sensitive data, knowing when someone is working, knowing what their tax elections are, tax benefits are, and tax and benefit elections are. And also we also know if there's wage garnishments. So that's why even for the smaller employers, I think it still takes 4 to 6 weeks. Yeah. the future of payroll companies do not like us to say that. I told that explicitly last week, actually.
When you have that tie-in,
Yeah.
you're tying into their payroll records.
Hmm.
What can you access?
So the individual's information is what we can access. So it's not like we can download the entirety of time and attendance for everyone. It's only the specific employee. I mean, the employee ID number is the most important thing that we really live and die by, because like that's really what keeps, we tie it to the individual on our platform.
Tied together, but the only way that you can access an individual's record in the system is through their employee ID number.
Right. So yeah, we don't have any social security number information.
Well, I'm just.
Sure.
Yeah. Just, I mean.
Well, these are good questions.
Sensitive about here and with privacy. And so we just want to make sure that there's not an end around where you're getting access to people's private information without their express consent.
Yeah, we agree.
The questions? Ryan, thank you.
Just ask about the 4 times
Mhm.
to get paid. Is that
So that's not for us, right? So we don't
you don't need that.
go into a bank account. I think that there are times when someone maybe has impersonated an employee and so taken access and paid themselves improperly. And so there is, I think, like when there's fraud that occurs, like there is,
Yeah,
that would be different. And I do believe that all of that is based on the Electronic Transfer Funds Act. And like there's a lot of, I think, there are federal rules. I think they are a floor that like states can build on top of.
you take possession of the paycheck and then just give the employee the portion that they don't owe you.
Right, the remainder pay.
Okay.
Right.
That's what I thought I heard earlier. and then-
Yeah. Yeah. So I think that has to make sure financially we're sound.
I don't know, I think you touched on it, but can you explain just the Visa card?
Yes.
So that is something that the employer signs up for via you, and then the employee has the option to
Right.
have that made available to them.
Right.
Now, are there other fees on top of?
So if they want to use it for the EWA service, it's the same pricing,
Okay.
unless you send your direct deposit to the card. So if so we have a free instant option. If you send your direct deposit to our card, with the exception of Connecticut, because so many people are asking us for instant options. And so people do not need to send their direct deposit to the debit card and they get free instant options. But that's only because we get a lot of consumer complaints. There's because we don't operate the same way we do everywhere else in Connecticut. Yeah.
And then is there, I know it's a debit card, but is there a credit override option?
I will find out. I don't know. It's whatever the rule is for general purpose reloadable cards is the same, would be the same way that our card functions. Because I don't think, that product is like not unique or really, I don't think new. I think that those have been around for a while.
Prepaid cards?
Right, exactly. Right, exactly.
Prepaid cards
Right.
is definitely for sure.
Right, yeah.
Like an employer giving you a prepaid card. is
Right.
definitely-
And there's definitely I do think there is a trend in the industry, like all of our competitors I know also offer a similar like debit card that have like on the B2B side that have like this really like the same sort of kind of fee structure where it's identical to sending it to a checking account, an external checking account unless you send your direct deposit there.
Okay. And do you have a sense on what the uptake is on that versus just using the standard EWA platform?
It's outside of Connecticut, it's very small. Yeah, people don't want to, like, when they see that they can't get a free instant option unless they send their direct deposit there, we don't see a lot of usage, I don't think. I can find out more though. I haven't updated that information, but Connecticut is where we have the most because there's no instant transfers in Connecticut. Because yes, yeah.
And then also on the instant transfer versus the kind of like slower option, are you finding a bigger uptake on the instant transfer? Are you people using the
Yeah.
free version?
So we find, people are not a monolith. We find that when someone does an instant transfer, they usually within the next two transfers that they do, they are going to do a free transfer just because they don't want to pay that $3.50 again. So we do see the majority of people do a mixture of the two. To be honest, over 2/3 of our usage, over 2/3 of the people on our platform take a 4-month to a 1-year break after they do one transaction. So we do have like a good number of people who are like infrequent users. Yeah.
Do you have a sense on what the percentage of people that are using the free service
Mhm.
versus the percentage of people that are using the pay service?
Yeah, I think it's definitely like in and around the 90s, the
90s?
people that are doing the instant. Like people want the instant, yeah. Which is why we had to figure something out in Connecticut.
Thank you.
Yeah.
On the free service, how many days does it take before the customer sees the money in their account?
We say it's 1 to 3 business days because if you do it on a Friday, it comes on a Monday, but it is typically like 1 to 2 days. Sometimes it's really more 1. I think it also depends on like the month. Apparently, the month of like I think in December money moves slower because of Christmas shopping and back to school in September. But it's never more than 3 days.
What?
Yeah, no. I think we have like an agreement with Visa, and they're the ones that we like hold them to that. Yeah, which I also think is customary for them.
Other question? Ryan, thank you.
Thank you.
You very much.
Mike online?
Yeah, right. It's tricky. This is a little bit. Get down through.
Mark, good afternoon.
Good afternoon.
Thank you for joining us this afternoon. We look
Thank-
forward to your testimony.
Thank you for having me. I'm thrilled to be here virtually, albeit, but I do love the state of Vermont, so I'm sad I couldn't come for this trip.
We are too.
Well, next time I'll be there in person, I promise. But thank you for having me. My name is Mark Salters. I am a public policy manager with a company called PayActive, a leading employer integrated earned wage access service that allows employees to access their wages before payday. We integrate directly into an employer's time and attendance payroll system and then verify their wages through that system, and then pay them when they request their money early. We partner with over 200 businesses across the state of Vermont and are proud to be a public benefit corporation and a certified B Corp. Over the last decade, we've seen the cost of living skyrocket in the United States, and up to 40% of Americans are living paycheck to paycheck. In Vermont alone, we've seen surveys suggest that 30% of adults report having difficulty paying for regular household expenses in the previous week. And without EWA, it might be weeks until these workers can see the financial benefit of picking up an extra shift so they can pay their electric bill, fix a flat tire, or buy some groceries for their kids that week. It's a significant financial security tool for thousands of Vermonters that need cash for unexpected expenses, and is a responsible alternative to high-cost debt options, such as payday loans and credit card debt. We are very supportive of this measure and creating a licensing system for EWA providers. We think that this has some of the strongest consumer protections of any legislation being considered, including requiring that mandatory fee-free option, ensuring all transactions are non-recourse, and prohibiting the use of credit scores or credit reporting so that any user has access to our platform. We also think that since we may hear that we're trying to evade lending laws, we want to point out that we are not. This treats EWA as any other financial instrument. It puts us under the Banking and Insurance Products Code in Title VIII, and we believe that we should be regulated just like every other financial instrument, like money transmitters, credit unions, insurance providers, loan servicers, and the like. We're proud of our commitment to Vermont and their workers, and we continue to partner with employers and employees at the state. And we really thank you for your leadership on this issue and request your support for this measure. And I really appreciate you taking time of your day to listen to me from this little spiel in my hotel room. So thank you.
Any questions for Mark?
So what are the what are the fee services and what are the free services on your account? I'm trying to find it on your website.
Yeah, so we have 5 free options that we offer to each user. The 2 ones that require a fee are, like the others have shown, the instant transfer option. So that's a $3.49 fee. Additionally, if you want to transfer the money to a non-pay active issued debit card, that is another $3.49 fee. And those are the only 2 fee options that we charge. Every other option we offer is free to the user.
So, sorry, just for clarification, so it is free for a person to have their money transferred into their bank account in
Yes,
1 to 3 days?
yes, that is free on our platform.
And
It's hard to
is
find
there
that
also
information.
a tipping option?
No, we do not. We do not have a tipping option. We only work with the employer directly. We don't accept tips.
Okay. Other question? Emily?
But you do manage chips for others?
No. You mean like, oh wait.
Manage for employees? But
Yeah.
let's hear here that you have tip and mileage as well.
Yeah, because since we are able to directly integrate with the payroll system, we can see that data, so we can be reflected in the amount of wages they can access. So like tips are included in that calculation as well.
And at what point do you have access to an employee's payroll records?
Yeah, so similar to how DailyPay explained it, it takes us once we agree to offer our services to an employer, it takes a few months for us to fully integrate into that system. We can see the data of the users from the employer that have enrolled. We can't see, the data of employees that are not enrolled in our system. After that, we can see the hours they've worked, how much wages they've already earned. They can request that access through our platform. The money is given to the employer who then gives it to the employee. And then when their paycheck is paid to them, whatever amount they've advanced is deducted and given back to us.
Yeah, I'm just curious. So I know you're doing the employer model, but do you also have direct to consumer?
No, we only offer employer.
Only offer, okay.
Question? Emily?
Sorry, I'm a little confused just looking at your website and the For You tab. Is that a tab that's directed towards consumers? Or
It's
is that,
that's directed towards users that are enrolled through their employer.
okay.
Yeah.
I guess you have the benefit of going last as part of the.
I know you pelted the others with questions. Yeah, thank them for taking the ones for me.
Very good. Thank you.
All right, thank you for your time today. I hope to be back soon.
Thank you.
Thank you.
Jeff is online. It's Jeff here. Jeff. Join us, please. Good afternoon.
Good afternoon. My name is Jeff Walsh, and I'm a senior attorney with National Consumer Law Center. And NCLC is a national advocacy group on consumer rights issues. We work primarily with consumer protection laws at the federal and state level, primarily laws regarding financial transactions, debt collection, mortgages. And I've worked at NCLC since 2008. And for 17 years before then, I was a staff attorney with Vermont Legal Aid. And during that time, I was able to acquaint myself with a lot of the financial problems that low-income Vermonters face. And I continue to live in Vermont, and I live in Westminster still at this point. I work remotely with NCLC. And I'm here to express significant concerns about this bill on behalf of both National Consumer Law Center and Vermont Legal Aid. We have significant concerns about the bill as it has a great potential, in our view, to undermine very significant consumer protections and caps on finance charges that have been built into Vermont law for many, many decades. We're concerned that by this type of characterization of certain, we call them fintech products, financial technology products, as somehow not being loans, not creating debts, they open up an extremely wide loophole for evasion of caps on finance charges, and they invite payday lenders that have been barred from Vermont up till now to imitate this type of model and adapt their own models to fit within this type of pattern of payday lending. And we think the basic problems with the earned wage access programs are that they're first very expensive, secondly, that they're addicting, and third, that they injure and harm consumers and borrowers. You've heard a lot of talk about, APRs as somehow being irrelevant, that you should just look the other way when somebody talks about 300% annual percentage rates as a finance charge. We think the APRs are a very useful model. They've been at the core of consumer protection laws that allow consumers to evaluate the cost of credit and make intelligent decisions about the type of credit that they assume. And the studies that have been done of earned wage access programs generally show that the APRs are well up into the triple digits. The CFPB just came out with a study last July indicating that nationwide earned wage access programs have typically about 156% APR as their finance charge. And there are many that go up to 300, 400%. The other danger with the programs is that they are based on a need. There are private equity firms, private equity funds investing in these earned wage access programs because they tie the programs into a vast array of low-income people who are living paycheck to paycheck. And the economy of scale is enormous, where you can get a few dollars per transaction from hundreds and thousands, millions of people. And this makes them very attractive to some of the largest private equity firms in the country to invest in. The premise here is that borrowers will become repeat users of the earned wage access programs. The CFPB's most recent study showed that on average, consumers are using these programs 2 to 3 times per month. They are, in a sense, paying to get their wages. They are incurring more debt that leaves them less able to meet their important necessities because they are paying the fees that accrue on these earned wage access programs. And one of the dangers that we see from these programs is, and the Center for Responsible Lending documented this in a recent report, are they frequently lead to overcharges, to default fees in bank accounts. In their study, they looked at borrowers for 3 months before they started earned wage access programs, and borrowers that had no overdraft fees during that 3-month period generally had 2, 3, and maybe up to 35 default fees on their accounts after they entered into the earned wage access programs. So it's not just the cost of the programs, it's the likelihood that things like default fees and other non-payment fees on bank accounts are going to accrue. We think that you should take a very close look at the interpretation that the Consumer Financial Protection Board released on July 18th of last year. The CFPB did a very thorough study over a couple of years leading up to this interpretation, where they conclude that earned wage access programs are loans, they are extensions of credit, they are subject to federal statutes like the Truth in Lending Law that require disclosure of annual percentage rates, and that the whole array of protections that apply to loans and disclosures of credit terms and APRs should apply to earned wage access programs. It's not accurate to say that the CFPB abandoned that interpretation. It was just issued in July. We comment frequently on proposed regulations for the CFPB. It can take a year, 2 years before they're finalized. It was not abandoned. And the CFPB's inquiries into earned wage access programs have not been as confusing as I think was suggested. The CFPB a couple of years ago temporarily approved one program with very unusual structure for an EWA program and allowed it temporarily to proceed. 2 weeks ago, the CFPB issued an order revoking that permit, declaring that that was no longer valid. The CFPB issued one other advisory opinion, but after doing more research and publishing that research last July, they've concluded that, in fact, the earned wage access programs are loans that shouldn't be subject to all of the disclosure requirements of federal law. And since then, about 21 state attorney generals have signed on to a letter agreeing with the CFPB's interpretation of the Truth in Lending Act and the applicability of lending disclosure laws to earned wage access programs. The attorney generals of New York, Massachusetts, Rhode Island, Maine, and many other states have signed on approving that interpretation. It is not some random analysis that was just published blithely by the CFPB or that they somehow abandoned. It was a very thorough analysis that is based on data that the CFPB assembled after several years of research into earned wage access programs, and is their conclusion after that review. There have also been enforcement actions against earned wage access programs by states like Connecticut, by the District of Columbia. The District of Columbia in November of last year filed a major lawsuit against an earned wage access program because it was charging finance charges well above the 20% limit allowed under District of Columbia law. What I think is important to keep in mind is that Vermont does regulate wage assignment programs. There is a licensed lender law that the Vermont legislature enacted in 1996. It describes the type of loan called a wage assignment. And many states have passed similar law to regulate wage assignments. Wage assignments are considered prone to abuse. They're a very secure lending practice for lenders, but they can be very harsh in terms of their impact on consumers because consumers essentially provide a portion of their wages to guarantee the payment of a loan. And the Vermont statute at 8 VSA 2234 defines agreements where an employee assigns a portion of their future wages to a lender in order to pay back a loan as a loan that is subject to regulation in Vermont like any other loan. And it defines the finance charge related to a wage assignment as anything that the lender collects over and above what they lent out to the borrower. So if you have a $100 loan and the borrower has to pay it back in a week, and they pay a $3 charge along with the repayment of the $100 through their wages, that $3 is a finance charge. And if it was loaned on $100 for a week, it's about 156% APR. Finally, the the earned wage, or rather the wage assignment law in Vermont puts a cap on what lenders can charge for a loan based on a wage assignment, and that cap is 18%. That is the cap on wage assignment loans that has been in effect in Vermont since 1996. And if you look back and you think about 1996, well, lenders had a lot of overhead compared to what they do now in 1996. This was before internet loans, before electronic transfers. You went to an office, you called somebody up on a phone, you used the US mail, and you made paper transactions. And the Vermont legislature in 1996 concluded that 18% was an appropriate annual percentage rate to cap on these type of wage assignment loans. Now you have this kind of perverse situation where it's infinitely cheaper for the lenders to implement these loans. They do them electronically through a couple clicks. They have basically no overhead. Yet they're asking you to allow them to have unlimited finance charges of 150%, 200%, 300% annual percentage rates for the same type of transactions that, as a legislature, you decided back in 1996 that 18% was fine. There's no reason why any technological development that makes lending easier should result in making the cost of the loans 10 times higher. That just doesn't make sense. Part of what is happening here is the attempt to characterize earned wage access loans as something other than loans. And that is fundamentally, that's the goal of this statute. That's what the lenders want. The key provision for them is section 2507 on page 13, where they want you to say that earned wage access programs are not covered by the licensed lender law. They don't want them subject to the 18% cap that you set back in 1996. And their way around that is to try to convince you that somehow this is just employees getting their own money. And it's really not a loan, so you shouldn't regulate it like a loan. That's the pitch. In fact, that's just not accurate. When a worker clicks on the buttons and asks for $100 from EarnIn, EarnIn pays that $100 out of EarnIn's money. It's not the worker's money, it's EarnIn's money. The worker gets the $100. There's a contractual agreement where 5 days or a week later, the worker has to pay that $100 back to EarnIn, and it's deducted from their wages, and there's a fee or charge added onto it. There's a finance charge added onto it. That is a loan, and that is a finance charge under any commonly accepted definition of what is a loan and what is an extension of credit. It's what the CFPB in July said was an extension of credit under the Truth in Lending Act, and you have to disclose all of the finance charge disclosures like any other loan. It's also what the Vermont legislature said was a loan back in 1996. The other aspect that I think is confusing and that is part of the pitch is that somehow the finance charges, because they're characterized as voluntary or as quick payment fees, are somehow not finance charges. So you shouldn't treat them as part of the cost of credit. And again, the CFPB analyzed those arguments thoroughly in their July 18th, 2024 analysis. California Banking Department did as well, and they've all concluded that these voluntary fees, these voluntary charges, are incidents of the extension of credit, therefore they're finance charges, and they should be disclosed as a finance charge. The fact that they're voluntary does not make a difference. The definition of what a finance charge is that it is a fee that is closely related to the extension of credit or an incident of that extension of credit, and that's what these fees are. The people who develop these programs know that when there's an option for a slow payment and a rapid payment, just about everybody's going to choose the rapid payment. So they make their money by charging for the rapid payment. Hardly anybody asks for the slow payment because they know that this is a vulnerable group that needs the money right away. And they design their business model to basically prey on that group of individuals in financial distress. The same is true with the tips. As I mentioned before, these are some of the largest global private equity firms investing in these platforms to harvest fees from consumers. When you look at their websites, they solicit fees and tips as if they're some type of a charity or a nonprofit or a cooperative, that they're asking you to give this money because you're helping out people just like you. They're asking basically poor, low-income consumers to give tips to help out private equity firms based in London or all over the world who are investing in these programs. It's not going to be possible to regulate those tips outside of simply holding EWAs to the existing requirements under Vermont law that set a cap on finance charges. That finance charge cap has been set at 18%, and we feel that's the way that it should stay. This could be the opening wedge for a whole series of other innovative financial products that you'll be seeing. There are people who want to create programs that take part of all of your future wages as part of a student loan, but they won't say it's a student loan. They'll take part of your home value and say, well, you're just investing with them. It's not really a loan based on the incremental home value in your house. There is a gaping hole that will be created if these types of products are allowed to evade what have been very well-established standards for what are caps on finance charges and what are loans. And finally, we cited in our written statement some of these older Vermont Supreme Court decisions that go back into the 19th century. Vermont has regulated interest rates and usury very carefully since the 1790s. And it's interesting that this issue of voluntary payments came up in the 1820s. You can read Vermont Supreme Court decisions where lenders who violated usury laws would defend their actions by saying, well, that consumer just paid us the money voluntarily. We didn't make them do it. And what the courts repeatedly said was, that doesn't make any difference. You are preying on people in financial distress. They very often have no other choices. And out of a sense of conscientiousness, out of a sense of honor, they're going to pay what you ask them. And we don't think you should be able to abuse our usury limits and our interest caps by trying to portray these transactions as somehow voluntary. And this case law in Vermont goes well back into the 1820s that holds that these types of voluntary payments are still finance charges. They are subject to usury laws, and you should treat them as any other finance charge under the interest caps. So we hope that you'll look at some of the material that we've sent in, and particularly at the CFPB analysis that came out in July that has not been finalized, but is still under review. And I think it's an excellent analysis of the issues that are before you here. And thank you for your time. And if you have any questions, I'll be happy to answer this.
I just want to reiterate something that I thought that I heard that I want to confirm, is that you said that we are currently regulating these businesses in BSA 82234. They're covered
Yes.
already, and
Yes.
there's already an 18% cap on the amount of money they are allowed to charge for interest.
Exactly. Yes.
Okay, I have lots of questions, like how are they operating then, if this is, but I guess that somebody would have to, the Attorney General, somebody would have to come in and say that this is.
Yeah, so that's why they're asking you to say that they're not subject to that law.
Yeah, but they've been in Vermont for a number
Yes.
of years now.
Yes.
Nobody has called this out.
That's true in many jurisdictions, but as I mentioned, Connecticut, District of Columbia, and certainly in New York have brought legal actions against some of the same folks that are coming before you here for doing the same things. I can't explain why somebody in Vermont hasn't brought a case like that. I think it would be appropriate, but I don't know.
Thank you.
The case law cited is as anything coming from 1827. It's kind of fascinating. One of the elements that's quoted is being usually in embarrassed circumstances. And I'm just wondering if you could explain the tie between embarrassed circumstances and this activity.
Sure, this is an activity that's targeted to the 50 or 60% of people who are living paycheck to paycheck. And I would consider that embarrassed circumstances. These are people who are desperate, that maybe have been turned down by other potential creditors. And what Justice Skinner was talking about in 1827 was somebody who took out, I think it was a $700 loan and had to pay 20% interest, and brought a lawsuit to get the overcharge back again. And the lender defended by saying, well, he agreed to do it. What's wrong with that? And Judge Ritters went back into Old English case law and treatises, and there's actually a very acknowledged doctrine that's gone well back into English common law that has rejected this notion that voluntary payment of a usurious loan makes it legal.
Forgive my ignorance on this, but you say that that's capped here at 18% in the
Yes.
state of Vermont. So why is it that credit card companies can charge 20, 30, whatever percentage? How come no one's ever done anything there? And the other question I would have is, when you have like a lender for like a mortgage, they have loan origination fees and all these different fees, but yet they're not calculated in the APR.
Right.
So I'm curious, why is that?
Sure. Yeah, there are a hodgepodge of usury laws, both at the federal and the state level. If you look at 9 VSA section 41A, that's the usury cap statute in Vermont. It's section 41A. There are, I forget the exact number of subdivisions, but there are many, many subdivisions, like from 1 to 20, of different types of loans that are subject to different types of caps.
Okay.
There is one particular category, I think it's subsection 1 or 2, that is called, it's a single payment short-term loan. That's the type of loans that wage assignments are.
Okay.
And the wage assignment statute that defines wage assignments as a loan refers back into Title IX to the usury law. And that's the particular subsection. So you're right, there are federal standards for credit cards. There are limited federal regulation of mortgage interest rates, but not very much. There's federal regulation of fees and costs associated with mortgage origination and with some servicing, but not really on just general interest rates under mortgage. And the same is true for credit cards. The credit card laws are basically geared toward disclosures. That's why you get these big fat statements with all the disclosure statements. But the caps on this type of loan, like payday loans too, they're typically limited by state laws. That's why Vermont had the good fortune of not allowing payday loans. And the state can do that. Their abilities to do that for other types of transactions might be preempted by federal law, but states can regulate wage assignments and states can regulate payday loans.
Okay, thank you. That helps.
Could you repeat that reference for 9 VSA for the usury law?
41 small a, that has the usury caps.
Okay.
And I think it's subsection A1 or A2 is the one that would apply, that applies here to the wage assignment.
Yes, thank you very much. We are due on the floor at 3 and we shut down our committees 10 minutes prior to the floor so we can be here on time. I appreciate you coming in. If there are other questions, committee members, you can get in touch with Jeff. If you're willing to chat with us some more,
Sure.
if you want more information, would you be willing to either join us on Zoom or come back?
Yes, sure. And both Grace Pasden for Vermont Legal Aid and we have our contact information on the written comments that we submitted. Thank you very much.
Thank you. Thank you. Colin? I'm sorry, we're not gonna be able to get to you today, but we can schedule, we're gonna schedule more testimony on Tuesday.
Yeah.
So if you can make it then, that'd be great.
That'd be great, yeah.
Perfect. Any questions, committee? So, we'll be done for the day after the floor. Back in here at 8:45 tomorrow to have a conversation with our UVM intern, and also if you have seen anything from the other committees, what's going on